Hey everyone, my name is Jack. Welcome back to the channel. This is another episode of my M1 Finance portfolio series where I'm trying to build a $100,000 portfolio in this platform, M1 Finance. It is a free to use brokerage. It's one of my favorites. I always have an affiliate link in the description below if you want to check it out. And I actually have a full tutorial series going over some of the features of M1 Finance if you are at all interested. So be sure to check that out too. I'm over halfway to reaching my goal of $100,000, but I'm actually down a bit from last month since there's been a bit of a pullback in the market. Not too much, but there was actually a pretty sizable one in my metal slice, which has a lot of gold and silver holdings. But anyways, I want to just dive right into going over some updates of the portfolio before I get into kind of the big thing that happened really outside of the portfolio that has a lot to do with this extra feature on M1 Finance, and that is borrowing. So I'll get into that in just a second. But not too many updates in this portfolio for the last month. I added a little bit to the Covered Call ETF, which was a new position that I added in the last episode. This is an income-focused ETF that uses covered calls on the S&P 500, which means that they're selling a call above whatever the strike price is during the given time that they open up the actual contract. So they collect a premium up front, and then if the market doesn't get up to that strike price, then they still get to keep that income. And even if it does get to that strike price, then in that case, they'd be forced to sell the underlying stock in the S&P 500. So they wouldn't be really any better or worse. The only problem is they'd miss on any gains above that, whatever the actual strike price was. So that's the risk you have there. And then of course, there's also downside risk too. If the S&P falls, this ETF still owns S&P 500 shares. The difference is you're taking money off the top with covered calls. So it's a lower risk, lower reward strategy when compared to just putting your money directly in the S&P 500. And it's not as though one is necessarily better or worse, depends on your risk tolerance, but that's kind of what it's going for. I think it is a somewhat decent replacement for higher yield bonds in this market where fixed income just really is not doing well because of everything that's happened with inflation. I just don't like that. Even though there is some significant equity risk here, I think it fits that profile a bit better. And then I have some significant income coming in, which can be helpful for paying down debt since this is a monthly payout, which is helpful when I have the amount of debt that I do. Having that extra income coming in not only helps for rebalancing my portfolio towards other opportunities, but also for actually making debt payments if that is something I'm looking to do. So I don't mind having the income, even though it might not be as tax efficient as other strategies. It seems like it fits the greater scope of my portfolio since it is a relatively small portion because it's only making up a couple grand out of the 54,000 if you include my cash balance that I currently have in the account. So that's my covered call position, but I also added a bit to my Equity Commonwealth position. That is the REIT owned by Sam Zell that's in the middle of trying to do a merger with Monmouth Realty to become an industrial REIT essentially. So that'll produce some significant income in the future as well, I would assuming that deal goes through and everything goes well, and also assuming that Zell just doesn't sell everything off. But even then, you'd still potentially get some pretty significant dividends because that's usually the way that REITs, which is a real estate investment trust, that's how they make their returns. They pay them out through dividends because really they're required to in order to keep a special tax status. That's why REITs typically have much higher dividend yields. It's because they're really forced to pay everything out as dividends, in most cases, not always. So I'm up to $13,000 invested in this specific holding in Equity Commonwealth. It is my second largest holding in my overall stock portfolio. I do own some stocks outside of this M1 portfolio, mainly over-the-counter stocks that you actually can't get on M1. That's one of the limitations. So my largest holding is actually Pershing Square Holdings, which is the hedge fund run by Bill Ackman that I hold outside of M1 through Fidelity since they have over-the-counter market access, which M1 doesn't yet, though I assume they will in some time in the future since they're constantly adding new features and new benefits. So be on the lookout for that. But for now, it's going to have to be outside of M1. But that's about it for my actual portfolio updates. If you guys want to see all the specific holdings in this portfolio, or at least all the target allocations that I have for them, you could check it out in the link in the description. In every single episode, I'll include a link to my M1 Finance portfolio for that episode. So if you want to copy it, it's not financial advice by any means, but maybe use it as a starter and then you can adjust it as you see fit, take some certain element of it, go ahead and do that. It's a nice feature with M1 as well. You can share your pies, as they call it, your portfolio, or even the pies within the pie, to then add to your own M1 Finance portfolio. And again, it's free to open an account, so I definitely recommend at least checking it out. If you open up an account and fund it, I might get a small commission, which would also help out the channel. But the biggest change, I hesitate to call it an update to the portfolio, but the biggest change within M1 Finance is the fact that I took out $8,000 in margin to pay for part of an upcoming real estate deal that I'm getting very close to closing on. I anticipate closing probably within the next week or two. We're waiting on the seller to do some repairs. I'll definitely update you on that, so be sure to subscribe so you see that. But M1 Finance allows margin loans, and there are plenty of risks to margin loans, which I'll get into in a second. But M1 Finance offers margin loans at this stellar 2% interest rate for M1 Plus members. And M1 Plus is their premium membership. It currently, I believe, is about $120 per year. I got it on a promo rate for something like $60 a year, which I think is going to be expiring pretty soon, so I'll have to pay the full $120 soon. But I think it's very worth it to get that extra interest rate, or that better interest rate, because normally it's 3.5%, which is still great, don't get me wrong, but 2% is a lot sweeter, and it'll be whatever a 1.5% difference right now compared to the actual base rate. That's the difference that an M1 Plus member would get. So I've done a breakdown on when that makes sense to pay the M1 Plus fee just for margin if you plan on using it. I'll include that in the description below. It's in the M1 Plus feature video, when it's worth it or not. I have a whole chart showing when it would actually be a break even to actually go for M1 Plus. So check that out if you're interested in something like this. But I decided to take $8,000 out. You can leverage up to 35% of your portfolio value. And for me, for Duffley Ventures, which is this main one that I'm showing, is about 18.5. So I could pull out up to $18,000 or almost $19,000 in margin right now based on my account value. And I took out $8,000 to use towards a real estate deal outside of this. And that is the big benefit to using margin. It's increased flexibility. I don't have to sell my holdings if I want to use this money towards something else. In this case, a real estate deal outside of M1 Finance, a real estate deal for my own portfolio, my own real estate portfolio, not buying REITs or anything like that. Though you could do that if you wanted to. I could leverage up this portfolio and add more margin debt into my cash balance and then use that to buy more stocks or buy whatever I want to buy. That is the flexibility you get with margin. You're not triggering a tax sale or anything like that when you use margin. Of course, the government could always change the rules and say that taking out debt triggers some sort of taxable event, but at the moment it doesn't, so we'll see how long it stays that way, but it's been that way for a long time. And that is a big tool that a lot of rich people use with all their assets, whether it be real estate, whether it be stocks. Instead of selling off those assets and paying taxes on the gains, if there are any, you can just use margin to take out whatever gains that were in there or some sort of proxy for the value. You take out the money using the debt. You don't have to sell, and then you pay back the debt later with other funds, maybe funds that you're actually making from your active income that's going to get taxed anyways. So that is one big way that a lot of wealthier people, or at least people who are very tax efficient, do things. They use debt. But debt is not without risk. Of course, if my portfolio value plummeted, then I would be on the hook for this margin, and it would trigger something potentially called a margin call, which is where the brokerage, in this case M1 Finance, would force me to liquidate my holdings to pay for the margin. I have collateral against this loan. The collateral is my stock portfolio. So if the stock portfolio falls in value too quickly and I don't have time to actually pay back the margin with other cash, then all of a sudden I'm on the hook via my actual portfolio, and I'm going to be liquidated probably at rock bottom prices, so I won't be able to ride the dip, which would be pretty rough, because that does happen in the short term with stocks. Even with a pretty well diversified portfolio, you could get some pretty significant dips in the short term, and that could trigger a margin call. And then by the time the market recovers, however many months or years later, if it ever does recover, then you are out of it. But M1 only allows you to take out 35% of your portfolio value in margin, so you're already kind of insulated there, in that you're not taking out, say, 80% of the portfolio value. So if it drops just a little bit, you're suddenly on the hook for a margin. In this case, it needs to drop quite a bit, even if you're totally maxed out, but still, that is a significant risk. It can happen in the stock market. We've seen pretty crazy things happen just over the last year and a half. Look at the massive crash we had in March of last year. Even with all the government intervention, it still was riding down very, very quickly. That could happen again. We'll see what happens with government action as well. You can never really figure out what's going to happen to the stock market in the very short term. And that's what the greatest risk is for margin. If something happens in the short term and you otherwise could ride the wave, but just don't have quite enough liquidity at that given moment to cover the margin, then all of a sudden you have to sell off part of your portfolio at potentially rock bottom prices, and that's no good. But anyways, this is really an example of what I want this portfolio to eventually become, and that is a sort of liquidity vehicle for something like real estate or investing in other assets. I'll have this fortress of a portfolio with lots of great stocks and lots of great companies, lots of great ETFs even, that are mixed into this portfolio that I could then leverage against using a ideally pretty cheap margin loan. Rates could always go up, but that would be a whole different ballgame. But at the moment, rates are low and they seem like they'll be low for the foreseeable future. So if I could have a very hefty stock portfolio, I could leverage that portfolio to then go and buy real estate. And then I could be a cash buyer for bigger and bigger deals so I can get them more easily. And then I could refinance out of them after that. Take the refinance loan, which is a nice longer term real estate loan, use it to pay back the margin, and then I can do it again. So it'd be a way to have some instant liquidity while still remaining fully invested, which is something that I am trying to do. I'm trying to be as invested as possible pretty much all the time because my portfolio really isn't that big. So having a massive cash allocation won't make a huge difference given the amount of money I'm bringing in now through my full-time job and because my portfolio just isn't that big yet. Eventually, my portfolio will be big enough to where having a significant cash allocation will make a pretty huge difference because I might have some big opportunities that come up and having that cash ready will make a bigger deal. But right now it just doesn't. Even if I have an extra 10 grand in cash, how much is that really going to do if I can get an extra 5% return or 10% return? It's just not going to be a whole lot in the grand scheme of things for what I'm trying to do. So I'd rather just try to be as invested as possible right now. Keep learning as I'm looking at different stock deals, looking at different things in the market. I'm learning as I go. Of course, we always are. So I'm going to become a better and better investor. This portfolio will get bigger and bigger, and then I'll have more options available to me because I'll have things like this margin ability to tap into the portfolio without actually having to sell. It's a pretty long-winded way of saying that I just want to have a larger portfolio because having a larger portfolio makes things easier. So anyways, once I close on this real estate deal, I'll probably have most of my new cash coming in from my income go towards the margin loan to actually pay it all the way back down to zero. And I could use that again to take advantage of other opportunities in the future. Again, I want to use this as a sort of piggy bank of sorts, a sort of reserve fund to invest in other things. That's what the margin is for, while I can remain fully invested otherwise. But when I say fully invested, I do have some pretty significant reserves set aside for my real estate deals so that if something pops up, I have cash available. It's just, I don't really count that as investable cash since that is kind of a given. You need to have some sort of reserves for real estate deals, especially when you have debt involved. You have big capital expenses, you have vacancy you got to look out for. So I always have reserve accounts there. So don't be fooled when I say that I'm fully invested because yes, I do have cash on the side and I think every investor should. But otherwise, that's it for this month's update. I want to hear your thoughts in the description below about using margin for something like this. Is that something you would do? Is that something you are doing? Or is that something you never touch? Definitely want to hear your rationale in the comments below. But like I said earlier, definitely check out the description below for links to M1 Finance, to the tutorial series I had to put together on M1 Finance, this actual portfolio if you want to copy it for whatever reason or adjust it. Again, not financial advice, but it's there if you want to check it out. And if you don't want to miss my monthly update on the series, be sure to subscribe. I put out a new episode on the 15th of every month, but I have other series as well that I do on this channel pretty regularly that I wouldn't want you guys to miss, so definitely subscribe so you don't miss any new videos. But until next time, take care.